Welcome to the Q2 investment update for Rights and Issues. I'm Dan Nickols and this is my colleague Matt Cable. We're both members of Jupiter's mid and small cap team and we took over management of the trust last October. Today we'd like to bring you up to date on our work to rebalance the portfolio, talk about a couple of new holdings and give our perspective on the current outlook for the UK small and mid cap market.
In our last update, we talked about some of the structural changes we're making to the portfolio. We said that we're planning on holding a broadly similar number of stocks, roughly 20 to 30, but reducing the concentration in the largest positions. We made some good progress there, having brought the weight of the top 5 positions down from 53% of NAV when we took the trust on to 47% at the last update and 41% at the end of June. The flip side of that is that we've reduced the number of very small positions. When we took the portfolio over last October, there were 9 holdings representing less than 1% of NAV each. So that's just one, and that's actually something that delisted several years ago and is carried at a nominal value. Today, there are probably 3 positions that are a bit bigger than we would have given a completely blank sheet of paper. But even there, we've brought the largest position in the portfolio down from over 13% to about 10.5%. Portfolio construction is always a dynamic process, so we'd never describe it as complete, but we're broadly happy with the shape of the portfolio today, so we don't anticipate making any large changes from here.
The other thing we talked about in our last update was adding more sectoral balance to the portfolio. And in particular, we've added 5 new holdings in the financial services and technology sectors. As you might expect, after the initial flurry of activity, we've been focusing to an extent on building those positions. Having said that, beyond the 5 we talked about last time, we've added a couple of new companies to the portfolio. One of these is another example of adding some higher growth technology to the fund, while the other is more about using the long-term structure of the trust to buy something we think offers really compelling value, but is more difficult from a timing perspective.
So taking those in turn, the first stock is a software business called Gresham Technologies. Gresham develops software used by banks and other large financial services businesses to reconcile very large volumes of complex data in real time, often across multiple systems. The way to think about that is that banks used to, once upon a time, be able to true up their records once a month, and once a week, and then it was once a day. But they're now expected to be able to look at all of their exposures, essentially in real time. And these days, regulators even expect banks to be able to report exposures to them in real time. So for a big global operation, that is a really difficult task, and that's where Gresham's products come into play. We like Gresham because they're essentially the only global player completely focused on this, so they get a dual growth driver, i.e. both the underlying market and share from more generalist legacy suppliers. The other new addition to the portfolio is very different. Marshalls is one of the UK's leading suppliers of heavy building materials, including stone, blocks and concrete roof tiles. Over the last year or so, this market has been very weak and Marshalls shares have fallen significantly. While it's hard to make the case for a dramatic recovery in the short term, we think Marshalls is extremely well run and will be a major beneficiary when their end markets recover in time. So while we understand that short-term traders will be wary of further weakness, with our much longer-term investment horizon, we think that the current valuation is an opportunity to add a great business to the portfolio at a really attractive price. We do recognise the risk of buying too early and catching another leg down in the price. We try to mitigate that by starting with a relatively small position and then building it up as we gain confidence in the timing of recovery.
Looking at the Investment Association's UK Smaller Companies Investment Trust sector, Rights and Issues has delivered a top quartile performance so far this year. It's worth breaking that down in a couple of ways. Firstly, on a pure investment return basis, the fund has outperformed the FTSE All-Share by almost 4 percentage points, which unsurprisingly is mostly a reflection of underlying stock performance, given this is essentially a stock-picking fund. As always, there are some puts and takes in there. We've seen some very strong performance from long-term holdings such as Hill & Smith, which is exposed to growing infrastructure spending, especially in the US. We've also had useful contributions from newer holdings, such as Alpha Group, which is starting to demonstrate the potential of its newer growth initiatives, as we'd hoped.
Inevitably, some things have gone less well, and here I'd highlight a long-term holding, Videndum, which makes a wide range of products that go into what they describe as the content creation markets. So this is everything from camera bags to cutting-edge video transmission technology. Unfortunately, they've seen simultaneous weakness in some of their consumer end markets, partly due to retailer destocking, and professional markets like Hollywood, where the writers have been on strike, which has delayed production schedules. Clearly, as we've discussed before, the key to managing this sort of trading volatility is to have a portfolio that's well diversified, but also well balanced across sectors and themes, without excessive concentration in individual stocks. And of course, we'd like everything to go well all the time, but that's obviously unrealistic. And it's sensible portfolio construction that ensures these stock-specific issues do not undermine overall portfolio performance.
The other aspect to overall performance for the year to date has been the notable narrowing of the discount, i.e. the difference between the price, the share price, and net asset value per share. We think this is mainly a result of the trust's inclusion in the FTSE All-Share Index for the first time following a review by FTSE Russell. Our understanding is that this should have happened a number of years ago, and the issue was only identified after being highlighted by a broker. Either way, it seems to have driven some additional buying interest, which has helped moderate the discount in the short term at least. When we discussed our investment process earlier in the year, we talked about the integration of top-down and bottom-up analysis in our thinking and highlighted inflation as a key issue. Given the data we've seen between then and now, this dynamic remains uppermost in our minds. While in the UK some prices, notably energy prices, have recently started to fall in absolute terms, and generally we are beginning to see reducing rates of inflation for many goods as global supply chains continue to normalise post-COVID, wage inflation in the UK has arguably proven stickier than elsewhere in the developed world, and this seems to be feeding through to services prices. So although the UK had been expected to be a disinflationary laggard, more recent data has seen markets move to price in a higher terminal interest rate, as fears of second round effects, that's a wage price spiral, can't be entirely ruled out. Precisely what impact this will have on the UK consumer is an open debate, but from our standpoint, this dynamic would seem to create more uncertainty over future consumption trends, and by extension, near-term share prices, especially for more overtly UK consumer-exposed and interest rate-sensitive stocks. And those of you who listened to our last update may also recall that our investment process also sets out the framework for the sector and thematic positioning of our portfolios. Inevitably, the US tends to set the tone for market trends and thematic leadership, even here in the UK. And yes, inflation pressures are evident in the US too. While the US Federal Reserve has made it clear that they have not yet reached the end of their tightening cycle, there appears to be greater confidence that the terminal rate is likely to be lower in the US, raising the prospect of an orderly slowing of US economic growth and a lower risk of second-round effects becoming embedded. We'll observe too that there's limited sustained thematic leadership in the UK small and mid-cap space. That's to say, our markets are not consistently being driven either by growth or value themes. Given valuation polarisation in our opportunity set, with some growth stocks continuing to trade at elevated multiples and some economically sensitive stocks trading at trough multiples of likely trough profits, and given an unclear economic outlook, we think it makes sense to continue to run a more balanced portfolio from a top-down perspective, with the aim being to generate alpha from stock-specific ideas. And finally, one thing we remain acutely conscious of is that it feels that the UK, and mid and small caps in particular, are still pretty out of favour with investors at the moment. And this naturally leads us to think what needs to happen for sentiment to improve and maybe drive a better rating for the sector. But from shortly before the vote to leave the EU in 2016, UK indices have derated relative to developed world peers. There are arguably a range of reasons for this. In my view, the supply shock to the labour market that the end of freedom of movement has caused is one of the obvious reasons for the current stickiness of inflation in the UK. Generalised uncertainty as to what the UK is trying to achieve in terms of regulation and trade policy in a post-Brexit world is also unhelpful. So what needs to happen? Government-led measures to incentivise investment in smaller growth-orientated companies may help, but achieving a more settled political backdrop post the chaos of the May, Johnson and Truss terms, and a greater level of political consensus around how bottlenecks in the UK labour market can be eased. While these solutions may prove elusive, we're fortunate in the UK small and mid-cap space to be able to select stocks from an opportunity set with well-managed, conservatively financed businesses that should be able to deliver attractive returns over time.
So if you'd like any more information about the Rights and Issues Investment Trust, please do visit our website or click on the link at the end of this video.